Welcome back, you legends. I'm Dr. Kal. Let's get right into this video. This is the most important video that I've made this year. Please stick around to the end. Click on your video settings, click on playback speed, set that to 1.25 to get through this video much faster. So let's get right into it. The stock market today closed up 0.4% on the S&P 500, up 0.6% on the NASDAQ, and up 0.45% on the Dow. Taking a look at the different groups today, leading the market were consumer defensives, utilities, followed by cyclicals, tech, healthcare, real estate, and communication services. Industrials and financials were flat on the day. Leading the losers was the energy sector, followed by basic materials. This is a defensive positioning, a defensive rotation here, guys. We're seeing the consumer defensive sector and utilities leading. These two are the most defensive parts of the S&P 500, and we're seeing a significant slowdown in the rally in tech, cyclicals, and communication services. So there's an internal rotation going on today, guys. We're seeing people take risk off. We're seeing people take some chips off the table and rotating into defensives. Let's take a look at the stock market map. Look at this, guys. Bright red on energy. This is a good sign if you believe that inflation has peaked and is declining. You want to see energy continue to decline, right? Big cap tech like Microsoft, Apple, Google, and Meta, as well as Amazon, are all basically flat. Tesla is up today after Elon Musk was boasting about the production hitting 1 million vehicles in China and 3 million vehicles total. So Tesla was up on that good news. Healthcare, we're seeing a defensive rotation into the big drug manufacturers like J&J and Eli Lilly. Right, financials, we're only seeing strength in MasterCard and Visa, so payment processors. Banks are mostly flat. And then semiconductors, we're seeing a bit of a rally in NVIDIA. NVIDIA was underperforming the semiconductor sector for a couple of weeks after the CEO came out and said that revenue guidance was cut by 20% for the current quarter. We'll see what kind of guidance they provide for Q3. If we get decent guidance for Q3, we could see NVIDIA start to rally. Let's take a look at the S&P 500. This is the daily chart. And look at that, guys. We are getting super close to a dangerous resistance level right here at $431 to $432. We have this descending resistance line coming in. We also have the 200 daily moving average coming in, and I do expect to see a lot of selling here, guys. A lot of hedge funds will start to take profits here and possibly rotate back into being short. So be very careful here, guys. We have this gap right here. I do expect to see this gap get filled very quickly. So in the coming few weeks, at least. And please, guys, stick to the end of the video. I'm going to talk about a bunch of different studies that will help us spot if this was the bottom or not. That will help us determine if this is a bear market rally or a new recovery, a start of a new bull market phase. Okay, so please stick around to the end. That's the most important part of the video. Please stick around to that. Additionally, guys, we have some more risks coming up. We have earnings for Walmart and Target coming in this week, and we have the the FOMC minutes coming out on August 17th. We also have this massive decline in the VIX. We've seen now 8 consecutive weeks of declines in the VIX. That is extremely rare. That is extremely rare. So we are likely to see a volatility pick back up. And when you start to see volatility move back up, that's when you will start to see the S&P 500 sell off. So we do have a lot of risks coming in this week, guys. FOMC minutes, earnings from Walmart and Target. Those earnings will add color to whether the inflation did in fact peak, or whether we are seeing some warning signs of inflation picking back up. The VIX is telling us that it wants to start moving back up pretty soon. We had this break below the ascending channel, which was a bullish development. We are still, guys, waiting for a bullish crossover on the daily chart for the VIX. On the PPO, that will be a massive sell signal when it happens, because again, guys, every single time it happened in the last year, here, and here, it marked the top in the bear market rallies that came at that time. In fact, let me lay the S&P 500 chart on top of here. Let's take a look at that, and just look at this, guys. Boom, we had that signal, we had that sell-off, signal, we had that sell-off at the top, signal here, sell-off and at the top of the rally, signal right here, sell-off at the top, signal right here, we had the top. A few days later, we moved sideways, and then we started to sell off. Okay, so this is an important signal. Keep an eye out for it. We will definitely update you when this crossover happens. Let's take a look at the triple Qs. The Nasdaq. The Nasdaq is also seeing some resistance up ahead here, guys. Very soon we will start to see the Nasdaq head into very major resistance. We have the top of the Bollinger Band right here at $336. And then we have this descending resistance line, right? This descending line goes back to November of last year. We had this brief false break, and then we had the massive sell-off and the beginning of the bear market rally, of the bear market, the beginning of the bear market. We do have this 200 daily moving average up ahead as well, so we might see the Nasdaq attempt to touch this 200 daily moving average before beginning to sell off. Now, let's take a look at the IWM. The IWM has already made it. We have already tagged the 200 daily moving average. The IWM has been significantly outperforming the S&P 500 and the NASDAQ since we had that June low here. That tends, guys, to indicate that this is a recovery, not a bear market rally. When you see the IWM beginning to outperform the big cap stocks, that tends to be a very important sign of the beginning of the recovery, because look at here, guys, we underperformed the big cap tech stocks, the S&P and the NASDAQ. We underperformed right here, we underperformed right here. So in every single bear market rally over the last year, we underperformed on the IWM, and we're now massively outperforming. In fact, let me put in the ratio chart here to show you guys what I'm talking about. Let's take a look at the weekly chart. Look at this, guys. At the bottom of the bear market, the last bear market in 2020, we had this consolidation phase in the IWM divided by the S&P 500. So in the ratio chart, as soon as we had that break out of the consolidation, we had a massive rally in the IWM. We're sitting extremely close at that level right now. So if we see a break above that, we will see a massive rally come in. That remains to be seen, but we will remain vigilant to see if that ends up happening, or if we see another pullback. Let's take a look at the dollar index. The dollar index is flashing a warning sign right here, guys. It remains to be in a downtrend. We do have wind at our faces in terms of the momentum. The momentum remains bearish. We do have somewhat of a double bottom formation here, but I'm not seeing a divergence. And on the smaller time frames as well, I am not seeing a divergence, right, between the momentum and the price declines, the price action, right? We had a low here and a lower low here. We also had a low here and a lower low right here. So I'm not seeing divergence just yet on the 2-hour chart. On the 1-hour chart, guys, we are seeing a divergence here. We had a double bottom here with a higher low right here on the momentum, and then we had that rally in the dollar. This remains to be seen if this is a rally in a downtrend, or if this is a new uptrend in the dollar. Most likely, if we see the market continue to recover, and if that scenario of recovery turns out to be the correct call, then the dollar will continue to decline. An important thing to look at is here, guys. We need to see a bullish crossover on the dollar. For the bear market rally thesis to be true, we need to see the dollar move back up. We need to see a bullish crossover right here, and that will trigger a significant sell-off in the market. If that ends up happening, again, an important level to look at is right here, guys, at 106.8 and at 107. If we see a break above 107, that will trigger a lot of algorithms to start buying the dollar, and that will probably lead to significant selling in the stock market. So keep this on your watch list, guys. Watch for a bullish crossover on the momentum to signal whether this is a false break in an uptrend or whether we are starting a downtrend in the dollar. Let's take a look at the 10-year yield, guys. The 10-year yield tends to move with inflation expectations. We did get this bullish crossover right here. We do have higher lows and higher highs. This does look like a possible bear flag right in the 10-year yield. I am still looking at the possibility of a head and shoulders formation with the shoulder right here, the left shoulder, and a right shoulder forming right now. That will signal the top in the 10-year yield, and a decline to the downside is very good for stocks. We need to see yields calm down and start to move down for the rally to continue. 2-year yields, guys, continue to show strength as well. 2-year yields are also tied with inflation expectations, and more importantly, they're tied to the federal funds rate. So these move alongside the Fed rate hikes. So we're still seeing strength here, guys. We had a double bottom here. We are flagging. We are seeing a bull flag right here. We do have a bullish crossover on the momentum. If we see a breakout in the 2-year yield, that will trigger a significant sell-off in the S&P 500. So watch this one. A break above 3.328% is what I'm looking at, okay? If you break and stay above, that'll be a warning sign to get out of the market. Let's take a look at oil. Oil has now made a significant sell-off today. Look at that. This is a significant sell-off in oil, down 7% since last week. This now looks like a bear flag. This could end up acting like a double bottom here, guys, because we do still have that divergence on the PPO. So if we see a break below, guys, watch for oil to go all the way down to $85 on Brent, on US oil, on WTI. Expect that to be down in the $80 range, okay? So watch for a break in oil. So far, we still have wind at our faces. The momentum is still bearish. So again, but we do still have this divergence here, guys, with a lower low here compared to here and a higher low on the momentum. So this could be bottoming. It will be very, very critical to watch what oil does. If oil starts to move back up, that will absolutely feed into inflation and will trigger the market to start selling off again. Let's take a look at Apple. Apple has been an absolutely insane tear. Let me take these out of the chart. Already much better. Okay, so the levels to watch. We have this descending resistance line, significant resistance for Apple. Look at that. We rejected systematically at this line. This rally is overdone, massively overdone. We are up 34% since the June lows. We are definitely expecting a sell-off in Apple, a significant pullback at least to fill this gap at $157, probably lower than that, guys. This is a significant zone, guys. It acted as support several times. Then once we broke through, it acted as resistance several times. So again, guys, watch for a pullback to this level, filling the gap, and to sit at this critical pivot zone. This is a pivot zone. It acted as a demand zone in the past, and then acted as a supply zone more recently. Once we broke through that, it will act as a demand zone again and will add as support, significant support to Apple. So watch for $155 on Apple. Let's take a look at Tesla, guys. Tesla is starting to look significantly more bullish. Why? We had this weakness in Tesla. As it turns out, it was because Elon Musk was selling. Elon is done selling, okay? We do have a split coming up on the 25th of August. And more importantly, guys, look at this pivot zone. It acted as significant resistance. We broke through that, right? We gapped below it, we broke through it, and we are now seeing buying off that zone and a recovery. So this is very good. This is a very good sign for the bulls, for the Tesla bulls. Now I do expect our next stop is around $1,000, around $1,050. So watch for a touch of this descending resistance line, this significant resistance line. So far, this looks bullish, very bullish in my opinion. A cup and perhaps a handle and then a rally. We will see. But so far, it looks bullish on Tesla. I like this setup significantly more than what I was seeing last week. Let's take a look at GameStop. Continues to show weakness. We have earnings coming in the middle of next month. Remember, guys, August, September, and October tend to see significant increase in volatility in the entire stock market. This includes GameStop. We did not manage to take out the previous high right here. We wicked through that and rejected, and we are now moving down. This is looking somewhat weaker than the rest of the meme stocks. Let's take a look at AMC. AMC is looking stronger, right? We had this wick through. We did not manage to make a higher high, but more importantly, guys, we did close above this 200 daily moving average. So that was a very significant development, a subtle technical change. But again, guys, subtle technical changes are often the most important. We're now still seeing strength in AMC. We will see if it will continue to chop here and start to move back up. That remains to be seen. I do not like the dilution that is coming in into the stock. That will hurt shareholders, so I am not a fan of that. My favorite out of all the meme stocks is by far Bed Bath & Beyond. I talked about this a lot last week. In fact, I was talking about it right here when we hit $8. I did say that I was going to buy into it. I did buy. I bought at around $10.9 right on this minor pullback. I am now up, I think, 30% on my position, a significant position. I bought 6,942 shares, so 6942. I picked that number on purpose. Okay, so I'm still holding. My first price target was $12.50. We hit that on the dot right here. My second price target is around $25 to $30. Right, we have significant resistance at around $25 to $30. We have the Fibonacci's, and then we have these significant resistance zones. So I'm watching for some weakness to come in at $25. That's when I will be absolutely selling half of my position for a 100% profit and letting the rest ride, completely reducing my risk to zero, right? I'm just going to let the profits ride for the rest of the rally, and I'll take my entire initial investment back to completely reduce my risk. So that's my plan as of right now. Price targets, more price targets. Next up, we have $50. That's a significant resistance level. Also coincides with a significant Fibonacci level, right? The 1 Fibonacci level right here. So again, significant level. After that, guys, we do still have another resistance level right here at the all-time highs at $80. If we break $80, and I do suspect that we will break $80, I expect that Bed Bath & Beyond will at least 30x from the bottom. The bottom was at around $4.50. Let's say let's call it $5. Okay. So if we break the all-time highs, I expect Bed Bath & Beyond to at least hit $150. Okay, if we hit 150, that's when I will be taking all of my profits. I'll be selling all of my shares at 150. So that's my ultimate price target. It could still move higher than that. It could go into 400 plus, but that's my ultimate price target. Let's take a look at the Fear and Greed Index, guys. We are sitting at a neutral reading. We're moving into greed. Let's take a look at the timeline. We're sitting at 55. The last bear market rally topped at 62. So it remains to be seen if this is a bear market rally or a recovery. Statistically speaking, guys, there's a 97% chance that this is a new bull market recovery, not a bear market rally. I'll go into those statistics later in this video. Please stick around. The $1 million question, guys, is whether this is a bear market rally or a new bull market. And those studies at the end of the video will help us determine that, okay? We look at data that goes back 20, 30, 40, 50 years to see whether this is a bear market rally or a new bull market. In terms of momentum, look at this. This is a significant development in the prior bear market rallies. We had a quick spike and a sell-off, quick spike, sell-off, quick spike, and a sell-off. We're now maintaining price action above the 125 daily moving average. So this is a significant development. Again, in terms of stock price strength, extreme greed, so expect some pullbacks. I did talk about that level right here on the S&P 500 at $410, 411, just about, okay? That also happens to be where the 100 daily moving average is sitting as of right now. So 410, I'll be looking very closely at that for a pullback this week or next week, okay? So very, very short term pullback. Going back to fear and greed, put to call ratio, sitting at a significant low. So puts are very cheap. So it is cheap to hedge your position right now. We tend to see spikes in the put to call ratio when we see a spike in volatility. So if you want to hedge your position, right now is a good time to do it, okay? To protect your position, please manage your risk. We're running into significant resistance. Market volatility continues to go down. We're now wedging. We're forming a downward wedge. As soon as we see that bullish crossover on the momentum, again, guys, that will trigger significant selling in the S&P 500. Please keep an eye out on that, and we will update you when it happens. Safe haven demand, difference in 20-day stock and bond returns, extreme greed, stocks are significantly outperforming bonds, junk bond demand, the HYG, the junk bonds, again, extreme greed, we're seeing a lot of buying in junk bonds. Very importantly, guys, very importantly, let me show you this chart, the high yield bonds. I have to show you this chart. Look at that. We formed a lower low. We had the spike. This is a topping formation, a Wyckoff distribution. This is selling. This is distribution. And let's take a look at the SPY, the 1 hour chart. We actually formed a higher high here. And on the HYG, we formed a lower high. This divergence, guys, tends to signal sell-offs are coming. And this divergence came in right here. We talked about it. We talked about it right here as well. So this is a very important divergence, guys. Please watch out. A sell-off is coming according to what's happening with the with bonds. Bond traders tend to be smarter than stock traders, and they are now selling. We're now seeing a lower high on bonds. So this is an important divergence. Please be careful and manage your risk at these levels. Let's take a look at the economic calendar. Today we had the Empire State Manufacturing Index came in at minus negative 31.3, the second lowest reading on record. The second lowest reading on record. That is insane, right? New York Empire State Factory Gauge plunges in August deep into contraction territory. Deep into contraction territory, right? We had a contraction in GDP in the first and second quarter. People are now saying that, okay, that was it. That was the recession. We're now recovering. That could be very possible, right? Statistics tend to support that thesis, but this is a worrying development. We do not want to see this or anything close to this, at least in the upcoming reading. Hopefully, the upcoming reading will be better than that. If it comes in very weak again, that'll be a very significant warning sign. This is the second largest monthly decline on record and among the lowest levels in the survey's history. Economists had expected a reading of 5, and we got a reading of negative 31. The shipments index fell 49.4 points to negative 24.1. That's a massive drop. We went from positive to negative with a significant percent drop. The New York data and similar reading from the Philadelphia Fed are seen as early indicators, leading indicators of things to come for the health of the factory sector in August. This is a leading indicator of recession. A leading indicator of recession, right? I want to show you an important chart, guys. This is the 210 yield curve, and it's sitting at deep inversion levels as of right now. This is the most significant inversion we've seen since the 1980s. And the deeper the inversion in the yield curve, the deeper the recession that it is predicting. And the yield curve inversion has predicted 100% of all recessions in the past 100 plus years. Okay, so this is one of the most reliable indicators for recession. It inverted twice. It inverted once here in March, right? This inversion, this tiny inversion, represents the small negative 1.6% and negative 0.9% decline in GDP that we've seen in the first and second quarter. So this tiny inversion, okay, reflected the tiny recession that we've seen. This massive inversion is predicting that a massive recession is coming. Okay, again, this goes hand in hand with the leading indicator of the factory numbers that we were just talking about. So even though things are looking really good in the short term, we could still see a massive rally in the stock market as the yield curve starts to steepen. Once we cross back over, and once the yield curve begins to steepen significantly, that's when we start to see markets crash. That's what happened in 2020. That's what happened in 2008. The inversion occurred in 2007, early 2007. We did not have the crash until a year later in 2008, okay? The yield curve inversion signal tends to have a 6 to 18-month lead time before the recession hits. Today we had the home builders index coming in at 49, significantly below the forecast. This is to be expected. We are seeing a significant recession. We are seeing a big recession in the housing market. This will continue to drag. For a long while, guys, because as long as mortgage rates remain high, the recession in the housing market will have to continue. And the deeper the recession the housing market gets, the worse the recession in the overall broader economy will get. The worst recessions that we've seen in history will all led by significant recessions in the housing market. So a recession led by real estate always ends up being very bad. Now, taking a look at tomorrow, we have the building permits, housing starts. I expect these to disappoint again. The recession in the housing market is real. Wednesday, we will have the Fed FOMC minutes coming out. We also have a bunch of Fed speakers coming in to speak. So expect volatility to come in hot and fast on Wednesday. Also, we have Walmart and Target's earnings coming in, and they are bellwethers of inflation. So brace for earnings fallout. We have Walmart reporting tomorrow before the market open, and then we have Target reporting on Wednesday before the market open. So I do suspect that we might see a touch of the 200 daily moving average on the S&P 500 right here, and then I expect to see price to begin to retreat to at least fill this gap right here. Now let's jump into the bottoming indicator. Please stick around for this. This is the most important part of the video. Enjoy. Now, guys, I do want to jump into the most important part of the entire video. Please stick for this one. This is the most important part of the entire video. This is where millionaires are made, okay? So what are we watching? This is the put-call ratio, the total put-call option volume. This is a contrarian indicator, guys. When people buy puts, you want to be bullish. When people are overly bullish and are buying calls, you want to be careful and taking profits. So what are we looking at here? Look at that, guys. The June capitulation bottom, look at that. If this is the bottom, it would make some sense because look at that. We had this massive surge and put buying. This tends to happen in stock market bottoms. The exact same thing happened in the 2020 market crash. We had this massive spike and we bottomed about 1 week later. Right here, we had this massive spike and we bottomed about a week later. Now we're seeing the opposite. We're now seeing people becoming overly bullish. We're now seeing the put to call ratio decline, meaning people are buying more calls, being more bullish, and so that's a little bit of a warning sign that we might see some consolidation, some pullbacks, right? In the 2020 recovery, we had this sharp decline in the put to call ratio. We ended up at this extreme level at the end of August, and then we had that massive sell-off right after the end of August, right? But if you take a look here, guys, we had this really quick run up when the put to call ratio was sitting at an even higher level compared to today. And then we had that massive spike. We had that pullback, declined, had another spike. We had that pullback. And then we had this massive melt up and a massive spike in the put to call ratio. People were getting euphoric as the market was going absolutely parabolic. And that was the perfect time to book your profits and turn bearish for at least a couple of months, a month and a half. because look at that, we did not recover for at least 2 months afterwards. We did not recover until about November. So I am still watching for something possibly like that, something similar to that to happen. We're sitting at a critical level here, a level where we've seen pullbacks in the past and some consolidation, some pullbacks. I'm still watching very carefully. I will try to add on pullbacks, more on pullbacks. I do not want to add on rallies. I do not want to open positions on rallies. I want to open positions on pullbacks. This again lines up with seasonality. August and September tend to see a spike in volatility, more so in September as compared to July. July tends to be a strong month, seasonally speaking. Again, we have seasonality. We have people being overly bullish. A lot of things are shaping up for a minor pullback to a slightly more significant pullback in September, possibly testing the lows again or coming close to testing the lows, depending again on what happens geopolitically and on what happens with the election. Let's take a look at fear and greed. Look at that. This is an extreme reading of greed. And when you see extreme readings of greed, you want to be fearful, right? Famously, Warren Buffett said, be fearful when people are greedy and be greedy when people are fearful. This was extreme fear. Right here, we ended up bottoming about a month and a half later, and now we're sitting at extreme greed. We could still rally. People can still get even more greedy. That is still possible, but we're sitting at a level where you want to take profits, not add to your bullish positions. This is Michael Burry. Michael Burry is known for catching the housing bubble and shorting the market and making billions of dollars. He's saying now the NASDAQ now is up 23% off its low. Congratulations. We now have the average bear market rally across 26 bear market rallies from 1929 to 1932. I do need to point out, guys, that the 1929 to 1932 is the worst bear market rally on record in history. This is nothing like that, okay? That's important to point out. So across 26 bear market rallies from 1929 to 1932 and 2000 to 2002, the average is 23%. After 2000, there were two 40% bear market rallies and one 50% plus rally before the market bottom. I think the situation is a little bit different now. The indicators are suggesting that we're not in a bear market any longer. Right, I will jump into those statistics. This study is from Chivaco Capital. Please check their videos out. They have a YouTube channel, an excellent YouTube channel. Please check them out. They looked at 61 different signals in 12 different studies going back to the 2000s. And we had a number of critical signals, the most important of which that I want to show you is this signal, guys. This is the S&P 500, a percentage of stocks above their 150-day moving average, going back all the way to 2002. When we go to extreme levels, right, sub 10, and then we recover above 35, anywhere between 35 and 40, that tended to signal the market bottom was in. This happened in 2020. That signaled the bottom was in. I was in fact looking at a rejection at 40%. If you look at the level here, we had this little dip right here that I was worried about. But after what happened last week, after that really strong close above the 50% retracement level, and now we have this massive spike up in breadth, right? It is looking absolutely different. This is a game changer in my opinion. Every single time we had a move from the blue line to the green line, the market bottom was in 2020, 2019, again 2011, again 2009 after that major bear market bottom in early 2009, and again after that major bottom in 2003. We did still see one last pullback in 2003. It was a significant pullback. It was a 15% pullback, and that speaks to these odds. That speaks to this worst case scenario that would take us down to $360 on the S&P 500, retesting the June lows. But again, if we continue to see strength this week and next week, the worst case scenario will start moving up, right? 15% down from $440, let's say, is still a higher level than 15% down from $427 where we are sitting right now. The median pullback in all 61 cases was 3.58%. The average pullback was 5.26%. I do not think that we will see the median or the average pullback. I think we will see a significantly stronger pullback than that. Again, because of the spike in volatility in August and September. And if we get more geopolitical instability, if we see a spike in commodities, in oil, if we see one more bad reading in inflation that goes against the consensus that says that inflation has stopped. In midterm years, we do tend to see that double dip into September, into October. So a lot of things do suggest that we will see a pullback that is significantly larger than the average pullback that we've seen in all 61 cases. In fact, if we take out all of the pullbacks that occurred in bull markets and only focus on bear markets, remember guys, we've seen a decline greater than 20% on the S&P 500, and that is a technical bear market. So if we only take a look at bear market pullbacks, in fact, the median is around 10%, 10 to 11% from current levels would take us to around $390 to around $380. And again, $390 to $380, that's exactly where we've seen that pivot, right guys? That is sitting exactly at the key pivot zone that I did talk about, right? Outlined in this blue line right here, where we had this gap fill. We had a couple of rejections right here, a couple of rejections to the downside, right? So acted as support here, acted as resistance there. So this is a key pivot zone. So let's assume that we go to around $430 on the S&P 500, right? That makes some sense. It's close to that 200 daily moving average. And then we see a pullback to that pivot zone. Look at that. Perfect, 9.5%. That makes a lot of sense. Next level right here, 12%, $378 also makes sense. So I'll be looking at both of these levels. I suspect that this will be a very strong support level, and a break below it will probably be a false break and will form a false break bottom. So this is a great example of how you look at macroeconomics, at statistics, at key technical levels based on the charts, and you put all of those things together to form a logical forecast on where the market could go from here, right? That's how you put it all together, and that's what successful traders and investors do. Now, I do want to point out some other critical studies that I want to show you. This is a corporate insider buy to sell ratio. Corporate insiders are an amazing indicator to go by, because they sell for a lot of reasons, but they only buy because they believe the price is going to go up. And they have insider knowledge. They know if the earnings are going to be bad. They know if the earnings are going to be good. So they have insider knowledge that we are not privy to, but we can follow their buys, right? And we've hit this critical buy zone mid-July, late July, and early August so far. So if you're a longer term investor looking, let's say, at a 3 to 5 year time horizon, this might be a good place to buy. And that's why I did in fact initiate my position on AMD, not because of insider buying, but because it made sense to me. It was cheap based on my knowledge of the semiconductor industry, and I did work in the industry for a long time. I do understand it very well. It made sense to me to be buying now when everybody's talking about the massive chip glut and the double ordering and so on and so forth. Let's take a look at the small trader put to call premium. Small traders are buying puts. They're being bearish, overly bearish. And unlike insider buying, small trader put to call premium is actually a contrarian indicator. When small traders are being bearish, you want to be bullish. And when small traders are being bullish, you want to be bearish. We tend to see this spike very close to the final market bottom. All right. So this speaks again to the odds that we might see a second test of the lows, or perhaps a pullback to that key $390 to $380 level on the S&P 500. Again, guys, look at all of these. They're all lining up. They all make sense. This is the hedge fund net shorts in the E-mini S&P 500 futures. This is another contrarian indicator. This is hedge funds being overly bearish on the market. That's one way to interpret this data. Another way to interpret this data, guys, is that hedge funds are actually buying stocks. Okay, they're buying stocks and they're hedging those positions with futures contracts. Okay, that's another way to think about it. You can think about it either way. You can think about it as hedge funds being overly bearish, and hedge funds are a lot like small traders, so you want to use this as a contrarian indicator. Another way to look at it is that hedge funds are actually buying. They're buying stock and they're just simply hedging their positions in case the market sees another dip. Again, this is a bullish indicator. When we see extreme readings like what we're seeing now, this tends to indicate that the bottom is in. This happened right here, 2020. Had this massive surge in bearishness after the bottom was in. Again, 2019, this massive surge in bearishness during the recovery, and we're seeing the same thing right now. This is how I'm positioned right now, guys. My investment portfolio at $1.126 million. I am sitting at 80% cash. I do have a position in AMD, a stock position in AMD, and I do have a stock position in Bed Bath & Beyond, about $75,000 each. They've both actually made significant profits for me so far. I am up about $16,700 on Bed Bath & Beyond. And I do intend to hold well into $20 and then take profits. And my options position is a put option, a $400 strike price put option on the S&P 500 that expires on September 30th. I did alert everybody in the group when I did this. I suspect that this will probably make me as a substantial profit, especially if we see that pullback to $380 to $390. If it doesn't make me a profit, this still buys me peace of mind as a hedge against my position in AMD and Bed Bath & Beyond. So that's how I'm positioned right now on my investment account. Again, guys, if you're interested in following my trades, trade ideas, investment ideas, levels, charts, technical analysis, mentoring, all of that good stuff, it's all in the private Discord group. It's $20 a month. If you want to support me, you can do that and you get access to all of that cool stuff. Other ways you can support me, of course, is to subscribe, comment, and like the videos. That helps me a lot because this is a small channel and we're trying to grow it one day at a time. Let's take a look at the beat rate. The earnings beat rate is sitting at 62%. This is, again, very bad. We usually like to see this sitting at 75 plus. So we are seeing a bit of a recession in earnings. If we see beats come back stronger in next quarter, that'll be a very good sign for the bulls. If we see beat rate data actually starting to decline, that'll be a bad sign. But the market seems to be pricing in that the recession is over, at least the small recession that we've seen. So, right, we had that negative GDP print in the first and second quarter. That technically makes for a recession, but the jobs market is still strong. That's probably what will take us out of this small recession. A larger, stronger recession is coming, guys. It will absolutely come. The inverted yield curve does predict that a recession is coming in perhaps a year's time or a year and a half. That's all I have for you today, guys. Thank you so much for watching. Thank you so much for liking, subscribing. I love you all, and I'll catch you in the next one. Bye-bye.
Oh, wow. Wow.